Vinci spent much of the 20th century under the ownership of major industrial conglomerates, including the Compagnie Générale d'Électricité, later Alcatel, and Saint-Gobain, before becoming an independent entity and rebranding as Vinci in 2000. By early 2026, Vinci's organizational structure has evolved into three distinct yet highly integrated pillars: concessions, energy solutions, and construction, each contributing differently to the overall strategic outlook of the enterprise. The bear case: structural risks and valuation headwinds. The bearish case for Vinci focuses on the group's vulnerability to French regulatory shifts, the impact of high interest rates on its heavy debt load, and the potential for overvaluation in its M&A strategy. French regulatory and fiscal fragility. Vinci's reliance on French motorway concessions remains a point of vulnerability. The ongoing political appetite for windfall taxes or infrastructure levies in France creates a ceiling for valuation multiples. Analysts from Bank of America have cited these tax risks as a primary reason for downgrading the stock to underperform in early 2026, noting that approximately 50% of the company's net profit is still generated in France. The expiration of major concessions between 2032 and 2036 also creates a terminal value concern that requires the group to continuously reinvest at potentially lower returns to replace lost income.
Interest rate sensitivity and the cost of debt. As a capital-intensive business, Vinci is highly sensitive to the cost of capital. While its debt-to-equity ratio of 0.52 is conservative, the group's average cost of gross financial debt has risen significantly from the lows of the early 2020s. The group faces a maturity cluster of debt issued during the low-rate era that must be refinanced at current market rates. If interest rates remain higher for longer, the cost of servicing the group's 19.1 billion euros in net debt will act as a persistent drag on earnings growth. Reinvestment risk and M&A multiples. There is a growing debate among analysts regarding the internal rate of return of the group's recent acquisitions. Some institutional researchers have expressed concern that the high prices paid for stakes in airports like Edinburgh and Budapest may result in returns that sit only marginally above or even below the group's cost of equity, estimated at 7.8%. The PEG ratio of 3.25 suggests that the stock may be trading at a premium relative to its muted organic growth prospects, which are projected at only 3.5% group EBIT growth over the 2026-2027 period. The bull case: catalysts for continued re-rating. The bullish thesis for Vinci is built upon its unmatched operational diversification, its pivot toward high-growth energy transition markets, and its superior cash generation capabilities.
Synergy of the integrated model and decentralization. One of the most significant advantages of the group is its integrated model, which allows it to finance, design, build, and operate infrastructure in-house. This model creates synergies that are particularly valuable in complex energy projects, such as the INELSI interconnection between France and Spain, where Vinci Energies, Cobra IS, and Vinci Construction are working together. Furthermore, the group's decentralized, multi-local organization allows individual business units to adapt quickly to local market conditions, while benefiting from the group's massive procurement scale and technical expertise. Growth in energy transition backlog. The energy solutions segment provides a structural growth driver that is relatively decoupled from the cycles of traditional infrastructure. With a record order book of 70 billion euros group-wide, the visibility for 2026 and 2027 is exceptionally high. The increasing global focus on energy sovereignty and grid resilience provides a tailwind that many analysts believe is not fully priced into the stock's current valuation. Free cash flow and dividend growth. Vinci's ability to generate 7 billion euros in free cash flow during a year of peak taxation in France is a testament to the cash-generating power of its concessions. The proposed €5 dividend for 2025 represents a yield of approximately 4.1%, providing an attractive income component for shareholders. The firm's commitment to a 60% payout ratio and its active share buyback policy provide clear mechanisms for returning capital to investors. Global diversification as a risk hedge. By generating nearly 60% of its revenue outside France, the group has effectively mitigated the risks associated with the French domestic economy and its regulatory environment. Germany is poised to become the leading international market in 2026, surpassing the UK, while expansions in the US, Mexico, and the Asia-Pacific region provide exposure to different economic cycles.
Company Deep Dive. Fiscal Year 2025 Performance and 2026 Strategic Guidance. The financial results for the fiscal year 2025, released in February 2026, underscored the group's ability to generate exceptional cash flow, despite a challenging regulatory environment in its home market. Revenue reached €74.6 billion, a 4.2% increase over 2024, with the international portion of the business continuing its upward trajectory to represent 59% of total sales. The group's operating income from ordinary activities rose 6.2% to reach €9.6 billion, reflecting an operating margin of 12.8%. This margin expansion is particularly notable given the inflationary pressures and supply chain disruptions that characterized the preceding 24 months. A primary highlight of the 2025 performance was the record generation of free cash flow, which hit €7 billion. This achievement was realized despite the significant impact of the exceptional tax contribution on large companies introduced by the French government, which resulted in a negative impact of several €100 million on net income and cash flow. Without this fiscal burden, the group's free cash flow would have reached approximately €7.4 billion, demonstrating the inherent strength of its underlying business models. The group's net financial debt was reduced by €1.3 billion during the year, ending at €19.1 billion, which corresponds to a conservative leverage ratio of 1.4 times EBITDA.
For the year 2026, the group has provided guidance that anticipates further growth in both revenue and earnings. The concessions segment is expected to benefit from the continued recovery and expansion of air travel, while the energy solutions segment is positioned to capitalize on the accelerating demand for electrification and digital infrastructure. Construction revenue is expected to remain stable as the group continues to prioritize margin protection over volume, a strategy that has successfully insulated it from the broader downturn in European residential property development. The concessions business, a global infrastructure portfolio. Vinci's concessions division remains the primary engine of profitability and the foundation of its high-quality earnings. This segment is divided into three main operational units: Vinci Airports, Vinci Autoroutes, and Vinci Highways, which together delivered an EBITDA margin of 66.9% in 2025. The concession model allows the group to benefit from long-term predictable cash flows, supported by inflation-linked tariff mechanisms and high barriers to entry. Vinci Airports, leadership in global air travel. As the world's leading private airport operator, Vinci Airports manages a network of 72 airports across 14 countries. The recovery in air travel following the pandemic has been remarkably resilient, with passenger numbers in many regions now comfortably exceeding 2019 levels. The 2025 growth was particularly pronounced in Japan, plus 10%, Mexico, plus 8.9%, and Hungary, plus 12%, reflecting the group's successful efforts to diversify its geographic exposure.
The strategic acquisitions of a 50.01% stake in Edinburgh Airport and a 20% stake in Budapest Airport in 2024 have been integrated into the network. The Edinburgh acquisition is particularly significant as it involves a freehold property similar to London Gatwick, which eliminates the terminal value risk associated with expiring concession agreements. For Budapest Airport, which operates under a concession due in 2080, the group has implemented a plan to optimize costs and expand routes, targeting a doubling of EBITDA by 2030. In Mexico, the group's indirect 29.99% stake in Grupo Aeroportuario del Centro Norte, OMA, has proven to be a high-yield investment. In late 2025, OMA received approval for its 5-year Master Development Program, which defines an €800 million investment cycle for 2026-2030. This agreement allows for tariff increases based on a formula of inflation plus 6.9% over the period, providing significant visibility for future earnings. The refinancing of 9.3 billion Mexican pesos in acquisition debt tied to this stake in late 2025 has further improved the investment's cost efficiency and tenor. Vinci Autoroutes and Highways, traffic resilience and fiscal challenges.
The group's motorway concessions in France, operated through subsidiaries such as Autoroutes du Sud de la France, Cofiroute, and Escota, remain the group's single largest source of cash flow. In 2025, Vinci Autoroutes reported revenue of €6.7 billion, up 2.3% from 2024. While traffic levels were affected at the end of the year by farmers' blockades in France, they rose by 0.9% overall. Light vehicle traffic increased by 0.9%, while heavy vehicle traffic grew by 0.7%, mirroring the broader economic activity in the region.
However, this segment faces two primary challenges: increasing fiscal pressure from the French government and the approaching expiration of its main concessions. The 2024 introduction of a 4.6% levy on revenue from long-distance transport infrastructure operators resulted in a €284 million impact on Vinci Autoroutes, and the subsequent exceptional corporate tax surcharge in 2025 further compressed margins. Concession durations for Escota 2032 and ASF 2036 mean that the group must continually seek new investment agreements with the French state to extend its operational horizon. Recent agreements for Cofirita's additional investment plan and Escota's maintenance and end-of-concession plan provide some visibility, but the long-term reinvestment risk remains a focal point for analysts. Vinci Highways, which operates international road concessions, saw revenue rise 35% in 2025 to €543 million, driven by actual traffic growth and the integration of new assets in Brazil and the United States. The acquisition of a section of the Denver Ring Road, Northwest Parkway, represents the group's first concession with traffic risk in the U.S., a critical step in its long-term strategy to expand in North American infrastructure markets. Energy Solutions, the new engine of growth. The Energy Solutions segment has emerged as the most dynamic part of the group's portfolio, capturing the accelerating global demand for electrification and digitalization. In 2025, this division achieved revenue of €29.6 billion, up 7.8% year-over-year, and now accounts for 40% of the group's total sales. The segment's operating margin improved to 7.6%, reflecting the successful integration of high-margin technical services and renewable energy projects.
Vinci Energies, which operates in approximately 60 countries, focuses on the modernization of industrial processes and the strengthening of energy and digital networks. Its Omixum brand is a leader in high-voltage and medium-voltage grid reinforcement, a market projected to see massive investment through 2030 as European and North American utilities adapt to renewable energy integration. The division's revenue reached €21.6 billion in 2025, with growth particularly strong in Germany, now Vinci Energies' second-largest market after France, and the Benelux countries. The order intake for Vinci Energies reached €22.3 billion in 2025, exceeding revenue for the year and bringing the order book to €17.5 billion, representing 10 months of average business activity. The division's focus on recurring maintenance and operational services provides a resilient revenue base, with a high cash conversion rate of 80% to 90%. Management anticipates a further margin expansion of 30 to 70 basis points by 2026, as the business mix shifts toward higher-value digital and cybersecurity solutions. Cobra IS and Zero E, the transition to a renewable producer. The acquisition of Cobra IS from ACS in late 2021 has fundamentally altered Vinci's growth profile. Cobra IS is an expert in applied industrial engineering, specializing in large-scale engineering, procurement, and construction projects for the energy sector. In 2025, the division reported revenue of €8.0 billion, a 13% increase driven by major projects in renewable energy and transmission lines.
The group's renewable energy production platform, Zero.E, has scaled rapidly, reaching a total capacity of 5 gigawatts, including assets in operation, under construction, and ready to build, at the end of 2025. The goal is to reach approximately 6 gigawatts by the end of 2026. Key projects in the pipeline include the Barrett Solar Project in Texas, a 172-megawatt DC facility slated for commercial operations in March 2026, and Bynum Solar, set to follow in April 2026.
In the North Sea, Cobra IS is working on 3 offshore wind farm converter platforms with a combined capacity of 6 gigawatts, converting AC generated by turbines into HVDC for onshore transmission. Cobra IS has also strengthened its position in the high-voltage transmission market, particularly in Brazil, where it is building several thousand kilometers of turnkey lines. The division's portfolio currently includes 4 public-private partnerships in electricity transmission, 3 in Brazil and 1 in Australia. While the expansion into renewable production requires significant capital expenditure, Cobra IS invested €0.9 billion in PV electricity generation in 2025 alone. The long-term goal is to build a portfolio of green energy concessions that mirror the high-margin, inflation-linked profile of its transport assets. Construction and Immobilier, profitability over volume. Vinci Construction remains the group's largest business by revenue, but it has undergone a pivot away from large, high-risk infrastructure projects towards smaller, specialized, and more profitable works. In 2025, revenue rose a modest 1% to €33.2 billion, while the EBIT margin improved to 4.2%. The division reported a record free cash flow of €1.4 billion, almost double the 2024 level, reflecting improved internal payment collection processes and strong cash inflows from customers at the end of the year.
Specialist businesses within the construction division, such as the piling contractor Solentanche Freycinet, have remained firm, particularly in high-growth sectors like the nuclear industry. Major projects now account for only 11% of division revenue, down from previous years, as the group maintains a disciplined and selective policy for new orders. The construction order book stood at €34.2 billion at year-end 2025, equivalent to 13 months of average activity. In contrast, Vinci Immobilier has faced the full brunt of the property crisis in France. Revenue declined 3% to €1.1 billion in 2025, and residential reservations fell by 13%. However, there have been signs of stabilization in early 2026, with an upturn in new project inquiries and a return to marginal profitability thanks to a more selective approach to development. Brokers in the French residential market expect a gradual recovery through 2026, driven by stabilized mortgage rates 3.2% to 3.4% and private capital investment. Valuation modeling. From a quantitative perspective, Vinci SA presents a complex valuation profile. While relative multiples suggest the stock is fairly valued, intrinsic valuation models often indicate a deep disconnect between the group's market price and its future cash flow potential. Valuation models for early 2026 offer several perspectives on the stock's fair value. Discounted cash flow, DCF. Fair value estimated at $223, representing a potential upside of 92.0%. Intrinsic value, FCF-based. Fair value estimated at €170, suggesting a 42.5% upside. Relative PE multiple, fair price calculated at €132.25, an implied upside of 10.7%. Analyst average target, consensus target price of €140.90. The wide range in valuation estimates reflects differing assumptions regarding the terminal value of the French motorway concessions and the long-term profitability of the renewable energy portfolio. Those who believe in the bull case point to the 13.2% free cash flow yield as a primary indicator of undervaluation, while bears focus on the regulatory headwinds that could compress multiples over time. Conclusion. Vinci represents a complex but fundamentally sound value proposition. The key variables to monitor over the next 18 months will be the progress of the portfolio review under CEO Pierre Angelaris, the stabilization of the French fiscal environment, and the group's ability to maintain its 14.17 PE ratio in the face of potentially rising refinancing costs. While the bear case highlights real regulatory and terminal value risks in the French home market, the bull case is increasingly supported by the massive scale of the energy transition and the group's demonstrated ability to capture international market share. Vinci remains a cornerstone asset for those seeking exposure to global infrastructure. Its record free cash flow, robust dividend growth, and high-quality order book provide a margin of safety.